Tata Motors posts a strong set of second quarter numbers. JLR margins have surprised on the upside, coming in at 17.8% versus 14.8%. Let's go straight across to Yatin Mota joining us with all the numbers and the analysis. Tell us, Yatin.
Well, Nisha, if you look at Tata Motors, a big surprise coming in here on the bottom line front as well as the JLR margin front, as you rightly mentioned. If you talk about the consolidated performance, a strong number coming in here. If you look at the overall sales that have been above the estimates, if you look at the profitability also, the company has posted a profit of 3,541 crores versus our estimate of 3,100 crores. So almost 15%. 18% kind of a beat coming in on the profit front. If you break down the consolidated performance into standalone and JLR, standalone clearly disappointing. We were expecting a loss of close to 600 crore for the standalone operations, but they have posted a loss of nearly 800 crores. Of course, they have done a provisioning of 200 crores as far as one of the subsidiaries concerned, and 80 crore is the kind of forex loss the standalone entity has taken in terms of the hit. So net if you adjust the standalone performance on the margin front also, which is 2%, has been in line with estimates, but the big beat is really coming in from JLR. They have posted a solid margin number of 17.8% versus our estimate of 17%. So, the most of the operating performance has really helped inch up the profitability for Jaguar Land Rover. If you look at JLR, their revenues for the quarter are at almost 4,612 British pounds in million. And also if you look at the EBITDA, that has come in at 823 million British pounds, much above versus our expectation of close to 800 million British pounds, so almost a 23 million excess in terms of the expectation. And if you look at the profitability also, that has grown by nearly 55% for JLR. So clearly, Tata Motors money-making machine, JLR, has clearly surprised the street. Let's see what the management has to really say in the press conference.
EBITDA came in at 9,200 crores, up from 5,800 crores same period last year. EBITDA margin 16.3, improved from 13.5, and profit after tax 3,500 crores compared to 2,000 crores in the same quarter last year. For the half year, the revenue was 1,03,000 crores, up from 86,000 crores. EBITDA margin 15.5 versus 13.9 for the last year, first half, and profit after tax 5,200 crores, up from 4,300 crores. As at September end, the net automotive debt equity was 0.26:1, reflecting a strong balance sheet at the consolidated level. Tata Motors standalone continued to have a very, very challenging quarter. The net revenue was down at 8,800 crores from 12,000 crores same quarter last year. EBITDA margin came in low at 2%, down from 5.9% last year same quarter. Profit after tax was a loss of 804 crores compared to 867 crores profit in the same quarter last year. But last year profit also included in Q2 dividend that we had received from Jaguar Land Rover. Half year Tata Motors standalone, similar picture. Revenue 18,000 crores, down from 23,000 crores in the same period last year. EBITDA margin 2.1% compared to down from 6.5%. Profit after tax a negative of 100 crores compared to 1,000 crores in the same period last year. Sorry. Yeah. Where is page up? Tata Motors standalone net debt equity ratio as of September was higher at 0.96:1. My apologies. Jaguar Land Rover had one more outstanding quarter. Net revenue up at 4.6 billion pounds, up from 3.2 billion pounds in the same quarter last year. EBITDA margin came in strong at 17.8, up by 3 percentage points a year ago. Profit after tax of 507 million pounds for the quarter, up from 300 million pounds same quarter last year. Jaguar Land Rover half year, April to September, again EBITDA margin 17.2, up from 14.6, and profit after tax 811 million pounds, up from 541 million pounds. The net debt was negative, and therefore the net debt equity ratio was negative 0.131, reflecting solid cash in the balance sheet and high level of liquidity. India business, as I mentioned earlier, continues to be impacted by very challenging macroeconomic conditions, slowdown in economic activity, low level of transport freight and infrastructure activity, tight financing environment, and diesel price increases have led to a very low vehicle demand. The competitive intensity continues to impact the overall margins. In our commercial vehicle business, our market share for the half year continued to remain strong at 57%. Passenger vehicle business, the market share for the half year stood at 6.1%. We have introduced several service offerings for the customers for the light and intermediate commercial vehicles, longer and extended warranty terms, Tata Alert service to support the customers, attractive AMC offerings, and increase in some of the product features. In the passenger vehicle business, again we are focusing on several service offerings under the brand promise, responsive, reliable, best value service across the company's national network. Exports grew by 19.1% quarter on quarter. We also entered new markets, Australia and Malaysia, with very strong local representation in these markets. Jaguar Land Rover wholesale and retail volumes for the quarter stood at 101,000 vehicles and 102,000 vehicles respectively, both up by 32% and 21%. EBITDA of 823 million, that is a margin of 17.8, is again up, as I mentioned earlier, arising from strong wholesale volumes, richer product mix, supported by launch of new Range Rover Sport, new Range Rover and Jaguar F-Type volumes, richer geographic mix, and also a 79 million pounds incentives we received in UK and other local markets. Free cash flow for the quarter and half year stood at 430 million and 89 million respectively, which is after product development and capital expenditure spend of 657 million and 1.25 billion for the quarter and half year. Mentioned earlier, strong balance sheet with significant cash and liquidity resources. Jaguar Land Rover business has also been upgraded in its credit rating by the rating agencies, and we have showcased Jaguar CX-17, a sports crossover concept at the Frankfurt Auto Show. In terms of geographic mix, the mix remains as it is earlier, UK, US, Europe, the China region growing a little further. Looking ahead, in our commercial vehicle business in India, we see economic growth will continue to remain subdued throughout this financial year, and therefore sale of CVs at the industry level will continue to be under pressure. Competitive intensity we expect to continue, which will bring further pressure on the manufacturers' margins. Couple of things that we can look forward to: better than average monsoon, which could trigger better rural consumption. Some of the projects which have been delayed for long or stalled beginning to show some signs of movement. JNNURM Phase 2 is likely to drive some bus volumes, and at the company level we will continue to focus on new products in the primer range, the ultra trucks, and product refreshes in our small commercial vehicles and pickups. We'll continue to explore further options for exploring the export potential. Passenger vehicle business will continue to remain focused on our strategy, which is in turn based on 4 pillars: intense product focus, world-class manufacturing practices, enhancing the customer purchase experience, and provide consistent, excellent quality of service to the customers. We'll remain focused on the launch of the CNG versions of Nano, Indica and Indigo, new product in the hatchback segment, new compact sedan, and refreshes on all existing products. As I said, for the commercial vehicles, we will focus on exploring the export markets as well for our passenger vehicles. Jaguar Land Rover, we hope to continue the sales momentum with the new Range Rover, Jaguar XF, Sport Brake, and Jaguar F-Type. We will continue with the successful launch phase of the Range Rover Sport and other new derivatives. Launch of the first world's premium diesel SUV hybrids in Range Rover and Range Rover Sport. We'll continue to invest in new products and new technologies to meet future demands. We'll continue to monitor the overall global trends and sales trends closely to balance sales and production. As reported earlier, we expect our capital expenditure and product development spend is likely to be around £2.75 billion this year. After the spend, we will continue to focus on generating strong cash flows. Thank you very much.